Hi, and welcome. You're listening to the X22 Report. My name is Dave, and this is episode 1043A, and today's date is August 8th, 2016, and the title of the episode is U.S. Government Recovery Statistics Are No Longer Matching the Collapsing Economy. Let's get into the economic collapse financial news. Now, Friday we had the job numbers come out, and we saw the market skyrocket. Good days are here again. Today, we see the market is down, gold is down a little bit, and most likely we will see gold suppressed a little bit during this whole week, and then most likely, maybe by the end of the week, we'll see it start to surge up once again. And we always know, once the gold starts to surge, we know the central banks are going to step in and suppress the precious metals market, because they need to keep the market down to convince everyone that everything is doing fine, everyone use the dollar, don't worry about gold and silver. That's just a piece of metal. We don't have to worry about that. And as we know, gold and silver, that is the money. The paper currency is what is really worth nothing. Now, out in Greece, we see that Greece is having a huge amount of troubles. And we should look at all these countries and compare those countries to the United States, because we will be entering a stage like this coming very soon. Once the system freezes up, once the credit markets freeze up, once the derivative bubble pops, once the stock market comes down, the housing market collapses, we will see our economy reflect what is going on in other countries. Now, Greece is seeing a decrease in exported goods. And the reason we're seeing this is because the Greek economy, it is completely collapsing. They have so much debt that nothing can be done there at this point. Capital controls, well, they're still in effect in certain areas. And there has been data published by the Hellenic Statistical Authority. And what they're saying is they're seeing a complete decline in exports. And they're seeing their exports for the first 6 months of 2016, they have come down to 11.97 billion euros. That's 8.1% lower than the 13.02 billion achieved year to year. So, as the Greek economy collapses, other parts of the country are starting to falter. And we're going to see this here in the United States. Now, of course, here in the United States, Canada, Australia, and many other countries, the private Western Central Bank countries, they're continually trying to just keep the illusion alive that everything is fine. But the statistical information right now does not make any sense. There's a huge number of anomalies. There's a huge number of discrepancies where it doesn't even make sense at this point. When we look at retail, we see the latest retail figures are out for July. And this is a complete dismal forecast. The Thomson Reuters same-store sales index registered a preliminary negative 1.5% for July, missing its negative 0.9% final estimate. And this is showing us that this midsummer retail sales extravaganza that the United States is trying to convince us of, the United States government is trying to convince us of, it's not happening. 66.7% of the retail stores, they've missed their expectation of what they thought was going to happen. And it gets even worse. The employment data that's coming out, according to David Stockman, when we look at this on a graph, he calls it a railroad track pattern. And when we look at this, it looks like it is a computer-generated algorithm that is controlling the employment series. Because when you look at it, you can see how everything is perfectly aligned, how everything is moving up all at once. And in past recoveries, we have never, ever seen this before. And when we look at this, it looks like a computer-generated type of recovery, because everything is perfect and aligned, moving up in unison. Now, when we look at these economic indicators, we see many different strange occurrences and things happening. If we look at the National Manufacturing ISM data, Not only are they regularly at odds with the PMI data released by market, but they're also at odds with numerous other data points. Looking at the ISM, the new orders, and industrial production, we have seen similar bounces after several very weak readings occurring shortly before the most recent two recession starts. These bounces turned out to be head fakes. So when we look at the ISM manufacturing and industrial production, we've seen these bounces before. Now, if we go back in time and we look at 1999 to 2000, we see the same bounce that is happening right now. And of course, as we know, in 2001, the system came crashing down. If we go back to 2008, we see the same exact bounce. Right afterwards, the entire system falls apart. If we move to 2016, we're at that point where we're seeing this bounce and everything is going to start falling apart. Now, when we look at the real gross private domestic investment, the RGPDI, this is the most reliable leading indicator of U.S. economic recession. Its trend has always reversed from up to down in advance of a recession. There have been no false negatives, and only in advance of a recession there have been no false positives. So when we take a look at this, we see the trend as follows. Prior to 2001, we saw the RGPDI start to fall, and then the crash came. In 2007, moving into 2008, we've seen the same thing. In 2016, we're at that point where the recession is about to happen. And if we look at total business sales to the payrolls, what do we see? Well, we see total business sales. They are in the negative range. Now, when we're looking at total business sales compared to payrolls are moving up. When we look at employment, we see employment is moving up. So we have a widening gap. We have the actual sales decreasing, but payrolls and employment are moving up. Now, when we look back in history, and we go back to 1994, and we look from 1994 all the way up to 2016, these three indicators have always been together. Sales increase, employment increases, payroll increases. Sales decrease, employment decreases, payroll decreases, and they move together. The only time we have seen these indicators move in opposite directions has been since 2012 to 2013 and forward to 2016, which makes absolutely no sense whatsoever. This is showing us once again the government statistical information compared to what's really going on. They're moving further and further apart. Reality compared to the illusion, they're not even crossing each other anymore. They're on the opposite spectrum of the economic situation. What is happening here is the government is losing their story on how this economy can be recovering. Yes, you can manipulate these statistics, and you can manipulate all the different numbers. But when people see stores closing, strip malls empty, people they know losing their jobs, can't find a job, or they lost a job themselves and they can't find one. Housing, if you're putting it up for sale, how come no one's coming to buy it very quickly when they're telling you that housing is incredible? Because what's happening here is they can change the numbers. They can't change reality. Now, there was a McKinsey study saying that this next generation, the children, are going to be worse off than their parents. Based on market income from wages and capital, the study shows 81% of U.S. citizens are worse off now than a decade ago. In France, the figure is 63%, Italy 97%, and in Sweden 20%, which shows us that this economy is declining quickly, and people are starting to realize that it's not going to get any better. And they're looking at all of this and saying, okay, my children are not going to be better off than I am. We talked about the housing market. Now, the U.S. government central bankers are out there telling us that we have this incredible market. Larry Young from the National Association of Realtors is telling us the market is incredible. I've been looking around the entire country, and you know what I see? I see housing prices coming down. I see people trying to sell their houses, and they're continually dropping their prices. Yes, people do believe that the housing market is great, so they're putting their houses up for sale. They're overpriced, and there's no traffic, and they're not selling. But there was a stress test for Fannie Mae and Freddie Mac. You remember Fannie and Freddie that needed a bailout? Well, the stress test unveiled that during a next crisis, Fannie and Freddie would not be able to exist without another bailout. They're going to need about $126 billion if something should happen to the economy. Which shows us once again, we're back in the same area we were in 2008. Nothing has changed. We see out in the UK that banks right now, they have announced a huge amount of losses. Now, of course, they're blaming this on the Brexit. So the Brexit happened. 1 month later, they're telling us there's a huge amount of losses. Well, the losses aren't from the 1 month. The losses are from what's happening in the global economy. And we're not just seeing it in the UK, we're seeing it throughout Europe, and we're seeing it in the United States. We see Barclays, the Royal Bank of Scotland. Well, their shares are down 17.4%. Barclays is down 15%. They temporarily suspended trading because the situation is getting worse and worse as time goes on. In Venezuela, which we mentioned many, many times before, the people there are having a very difficult time. And we know for a fact when this crisis hits the United States, we need to look at these other countries and how they're dealing with what is going on. And we can see that people are running around looking for food. They're looking for supplies. They're looking for anything they can get their hands on. And what we're seeing right now is that the people, they're lining up at supermarkets for hours on hand to get any type of food they possibly can before the supermarket runs out of food. People are stocking their homes up with diapers because they're very hard to find. And of course, as you know, when we go through this economic crisis, there will be different levels. So the first level of the economic crisis, when you start hearing the stock market come down, the housing market crash, they tell you about the derivatives, which most likely they won't tell you. They'll just tell you the bond market is starting to fall apart. Maybe they'll tell you that. When we start to see all of this, you will need the cash because that's what everyone knows. Everyone knows cash. So people will be running to the store. They'll use their cash to buy whatever goods. We'll see inflation at this point because the value of the dollar is going to continually drop. So you'll go to the market, you'll use your cash to get whatever you possibly can. This will go on for a month or two before the cash is worth absolutely nothing. Once that is over, people then will turn to bartering. They will not use gold and silver yet. They will say, hey, listen, do you have diapers? I'll give you water. Do you have food? I'll give you medical supplies. This will go on for a couple months. Again, they will not use gold and silver. When the system comes back online, hopefully in 4, 5, 6 months, maybe longer, depending, we don't know exactly how long it will take, that's when you will use the gold and silver, because they will reprice everything. That is your store of wealth. This is what you use at that point. The cash, they might give you 20 cents on the dollar. Supplies you'll use for bartering, and gold and silver at this point, this will be your wealth. And this is why everyone needs to be prepared for what is coming, because there will be different stages, and this is why you need the food, the water, the medical supplies, the toiletries. This is why you'll need cash on hand. You also need a weapon to protect yourself. You will also need gold and silver when the entire system is restarted. So if you haven't started to prepare, you should start now. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared. Thanks a lot.